Everyone can see my screen okay?
Yes.
Okay. Well, it's so good to see everybody and that the weather is turning a corner. I checked our weather, it's 50 degrees or will be 50 degrees. So not the 60s and then it's going to be 40 tomorrow. So definitely we'll try to get out and get a walk today for sure. But it's so good to see you all. Welcome new members. I know it can be stuff that we're going to go through. You might be a little confused at first, regarding our fund structure, how we invest, the partnership that we have. And I just want to offer to you that if you want to set aside some time, one-on-one time, for me to kind of give an overview of Wespath, who we are, what we do, how we do it, always happy to do that. So just kind of work through Dustin, and he will coordinate some time with me if this is something that you are interested in doing. So don't hesitate to reach out. I usually like to start off the meetings and talk about any new publications that we've done, keeping our clients informed and being transparent about what we are doing and how their funds have performed is really important to us. So we wrote some really lighthearted pieces towards the end of the year. One of them was Wespath staff members share holiday traditions. My youngest daughter, Molly, is highlighted in this article where we have a nutcracker collection. And as a family, we always pick a new nutcracker for the year. This year it fell on her birthday when we went nutcracker shopping, and most of them are very traditional. I have a very Irish background, so we have like one that has shamrocks on it, but they're still very traditional looking nutcrackers. Well, she picked a Scandinavian skier nutcracker that is not like the traditional nutcracker collection that we have. So there's a picture of it. So again, just really trying to make some lighthearted reads. And then we do obviously a key market takeaway. So what happened during the year, how that impacted our funds, kind of even a little bit about looking forward, what are things that could transpire in the coming years. But you all should be receiving these. I will make sure to add Carol and Garth to the distribution. I wrote myself a note so that you all begin receiving these. We send out a weekly email and it will have new articles. We also published a series where it talked about an exciting time to be a lender. So it really highlighted fixed income, private credit, active bond funds, and so forth. So if you hover over the link, it should hopefully work. And if it doesn't, I'm happy to send the links to people. It doesn't work. Okay. I will happy to send these articles. I can send it to you, Dustin, and you can pass this on.
It does work in the PowerPoint version, but I was having trouble getting this part to work.
Okay.
Thank you.
Yep. Let me write myself a note. And I will do that. Perfect. So kind of jumping into your accounts. And also I want to mention my colleague Raj Kahn's here. Raj participated in the last meeting or the August meeting. I was in person. Frank and Raj participated via Zoom. Raj oversees our risk and analytics. So he is the one that is engaging with the portfolio managers regarding, he looks at cash balances, if we're rebalancing, if we're doing manager changes. When you all do inflows and outflows of your account, Raj's team is part of that. So, and constantly doing analysis on the portfolio and so forth. So Raj is going to talk about the markets, and then he's also going to talk about our two equity funds, how they compare relative to their peers, what we're hearing from our investment managers, and just kind of spend a little bit more time talking about our US equity and our international equity fund. So feel free to, again, as always, ask questions as we go through the presentation. So starting off and looking at your accounts, you can see as of December, we ended with $67 million. We did see a nice pop in the market in the fourth quarter that started in the month of November and kind of carried us through the year. So it's a great way to end the markets for the year. Looking at your, I'm actually going to talk about the balanced fund last. I want to talk about the two equity funds first. So looking at our fixed income fund or your fixed income portfolio, it's invested 100% in our fixed income fund, which is 100% actively managed. PIMCO, their Core Plus strategy makes up a little over 45% of the fund. And again, it's a core plus strategy, so they can kind of navigate that yield curve, the other sectors of the fixed income market. And PIMCO's just done really well in this inflationary rising interest rate environment. So they've really been able to navigate the tightening cycle, and now really this soft landing that we are hopeful that we will see. So you can see for PIMCO, this market value of your fund is $7.8 million. And then you can see really the trailing performance, and this is net of Wespath fees, your performance that we are reporting. And just a reminder, the benchmark does not have a provision for fees, and we are showing you the net of fee performance. So you can see, over 1 percentage point for the year outperformance, over 1.35 percentage point outperformance for the 3-year. And then since you've hired us, the fixed income market as a whole is down, we're up modestly. We're in the positive territory. Looking at your equity account balance, you can see the market value of a little under $9 million. Reminder, we added a little over a year ago, we added in the index fund. So we lowered the international component, and then we added in the index component. One of the things with our fund, as a reminder, is we have that overweight to small and mid cap stocks. So we wanted to lessen that overweight in the US side. So we added in the index fund, which is managed against the Russell 3000, benchmark. So you can see the net of all fees, net of all performance below. For the 1 month, we did see our equity managers performed really strongly in the month of December. Really their strategies were in favor for this risk on appetite that we saw. We did have some strong absolute returns. So you can see for the 1 year up over 20% net of fees, for that 1 year time horizon, 3 month up a little over 10%. Again, just really coming off some of those dampened returns that we saw in the third quarter. In 2023, we really saw that kind of turnaround. One of the things, just talking about these specific funds, so the U.S. equities funds that are a part of your portfolio, the U.S. equity fund, the main drivers of the underperformance of the U.S. equity fund has been our underweight to those mega caps. Those mega caps, when we think about them, NVIDIA, Google, Amazon, Facebook, they were up a little under 100% last year. So we really saw them just really have strong performance, and that underweight did hurt us. Our active strategies within our U.S. equity fund, they have done well. I mean, Zevenbergen's done well. Raj will talk a little bit more about those managers. It's just the outperformance of those handful of names really caused the fund to underperform the benchmark, because the benchmark, has a higher weighting to those strategies. We do own those names. So I always remind people, we do own Facebook, we do own Google. We are just underweight relative to the benchmark. But we'll talk a little bit more about that during the fund, but I did want to, spend a little bit time talking about that with the funds. On the international equities.
Question.
Yeah.
I think Sean raised a hand.
Oh, sorry, Sean. You're not on my screen.
That's okay. I just had a quick question. You can decide if you want to talk about it here or if the two of you would like to talk about it later. But I figured that these numbers would look good. You guys have, at least ever since we've been working with you, you've had that overweight to the small cap side of things. Does that ever change? Do you guys ever make an adjustment to where you say, you know what, instead of being 600 or 700 basis points overweight on the small cap side of things, do we shift some of that back towards more of the large cap? So not saying that now's the time to do it or whatnot. I was just kind of curious if you guys have some kind of mechanism in place to have those discussions from time to time.
Raj, I can start it and then you can go into it. One of the things that we do regularly is we do engage with our managers on a regular basis. We have them fill out profile pages of things that have changed in the portfolio. And Raj and his team are constantly looking at, we get trade reports about what they're doing. If we're seeing things happen, we reach out to them. Right now, we are going through a process with all of our managers, specifically with our 2 equity funds, of re-underwriting them. So looking closer at them, looking at the analysis, it's, do these managers still make sense for this fund? How well are they complementing each other? How are they the dispersion of the return. Again, we don't want all of our managers to complement each other, but we want to make sure that we are getting compensated for risks that we're taking. We do have some diversification. So making sure we have conviction in their strategies, making sure that the fees that we have are, we're in the process of renegotiating some of our fees with our managers as well. Reaffirming the biases that we have in our funds. Again, the degree of our over and underweight of small and mid cap stocks and large cap stocks, or mainly the mega cap stocks. So there's a lot of work that's going on. This isn't something that's going to happen in the next month or 3 months or 6 months. It's been really something ongoing that we've been looking at and working on. So I think with that, I would say that we could potentially see changes in our strategy and how the biases that we have. But Raj, I'll turn it over to you. I know because Raj and his team is the one that is responsible for all of this work that we are doing. So
yes. So thank you. And that's a really good question, Sean, because I often find that it could sometimes be misleading when people look at our positioning and they think that's static. We just take on this big overweight here, a big underweight here, and that's it. Our fund is actually as Karen mentioned, there is ongoing deep dive work we're doing to determine how our model portfolio would look like and how we want to allocate money. Now, there is obviously some thinking behind some investment philosophies that determine how we did make those decisions. For example, large cap is a place where we want not too much active management because we feel in large cap space, it's hard for active managers to go out and find great names and outperform. The market is very well aware of large cap names and what's happening with them. But in small cap space, active management still has some good playing space, if you would. And so we kind of divide up the portfolio and put pools of asset in passive and active. But then within active management space, we give our small cap or mid cap managers a range to go in and out. If they don't feel they can find good small cap, well, they can go find something larger. So it's not like we're binding their hand and say, just buy small cap. So what this creates is managers' choices lead to how much overweight we are in small cap or how much underweight we are in large cap. If managers can find good opportunities, if they don't have conviction in the small cap company names, well, we don't want them to buy that, absolutely, and they don't. And we question their choices. We've seen our small cap go up and down. There's another piece to it, which is the benchmark. We are doing this analysis from portfolio decisions at the portfolio level. When you compare that to then the fund benchmark, well, the fund benchmark also determines how much we are moving. If the fund benchmark suddenly has all of its money in large cap, well, yes, we'll be even bigger underweight. So how the benchmark moves ends up changing our overweight and underweight. And I'll keep it to that level, but I'm happy to dive further in if that interests you.
Thank you. No, I wanted you guys to have an opportunity to kind of talk about that a little bit. I don't know really any managers that had the right type of allocation that they needed to the megas last year to catch that full upswing. And I do know that most active managers tend to lean on the small caps. And it was a very strange year last year, and it really is kind of still strange given the fact that S&P is running at all-time highs while you've got the Russell still 20% below its high. That's actually something that's never happened before. So oftentimes, if we are going to come out of something, if we are going to have this soft landing approach to where equities can really get bid back up, you would expect to see small caps kind of leading out of that. And we just haven't seen that yet. So no, I appreciate the explanation. And like I said, just wanted to give you guys a chance to kind of explain that. So thank you.
You're stealing all the bullet points I was going. The some of the items I was going to talk about. You just kind of said it, but
sorry about that.
A little bit deeper.
I'm sorry.
It's a strange year, and I have the hard work of talking about markets because, boy, I would love to hear somebody who can correctly explain what's happening in the market.
So can we cover that some more when you get back on page 31? I don't want to jump ahead, but
Yeah, we'll do. So this is leads a good time into talking about the multiple asset fund, because this is why I didn't want to jump to the multiple asset fund, but rather talk about the fixed income and the equity portfolios. Because a reminder, our multiple asset fund is 65% equities, 35% fixed income, and has a 35% allocation to our US equity fund and a 30% allocation to our international equity fund. So again, you can see strong returns in the 1 year. Really positive returns, especially coming out of the negative markets that we had, in the last meeting. But what's been impacting on a relative basis has been that underweight to mega cap stocks, and also the active managing in the international equity fund. And so this is why you see the underperformance. But the two fixed income funds have done well. So 35% of the fund, those managers have performed significantly, outperformed by over 200 basis points. But really the drag relative to the benchmark has been the equity fund components of this fund. And then looking at the short-term fund, its market value of over 2 million. This is invested 100% in our short-term fund, but I know Dustin has other strategies outside of us, a laddered CDs, and then the work with the development fund. That's also part of the Kansas Foundation's short-term fund. But the portion that we manage, you can see the net of all fee performance. Again, really strong numbers for the 1 year. We did drop the fee on this fund to around 20 basis points. So it dropped from a little over 30 to 20 basis points. So we had like a 10 basis point decrease in this fund that started in the middle of last year. So I did want to highlight that. And then here's our index fund, just as a standalone fund. You can see the market value and then the net of all fee performance directly below. Typically, the only thing that will be different from the benchmark when we see any variances in the returns will be fees, obviously. We also dropped the fee on this account, this fund too, in the middle of last year. So it's around 24 basis points all-in fee for this fund. And then the exclusions. So this fund actually owns the underlying holdings of the Russell 3000, most of the holdings, with the exception of alcoholic beverage, tobacco, gambling, adult entertainment, private prisons, and weapons. So all the companies that are outlined in the book of discipline that we should avoid investing in for that reason. So this is when you'll see a little bit of the return differences, the fees and those exclusions. If alcoholic beverage companies do well, then that's going to be a detractor for the fund. Any questions about this? And we'll talk a little bit more about the fund performance here in a moment, but I did want to make sure to highlight for the committee what's been the drivers of the relative returns. Okay, this is your financial reconciliation. I'm not going to go through all of it, but it just kind of shows how much money you gave, and this is for quarter to date, the withdrawals, and then your appreciation. So you had your capital appreciation on top of the contributions and withdrawals of a little over 5.3 million. And then for year to date, a little over 8.2 million that you can see. With that, I will turn it over to Raj. And Raj, you can just push me when you need me to change the slides.
Will do. Okay, thank you. And Karen, keep me honest with time. I can ramble on a bit, and I want to make sure I don't do that much.
That is a good point, Raj. Thank you for highlighting that. What time would you like us to be done with our presentation? I know we're likely not the only thing on your agenda, and we do want to be mindful of people's time.
Yeah, I think we're probably okay to go till, let's say, 10:20, something like that,
Okay.
with our total time with you, if that worked fine.
Okay.
And I think we have some of those implied some discussions later on, so that sounds good.
Okay, great. Thank you. Then I'll try and keep this market update piece around 20 minutes or so. I think that'll give us plenty of time to cover fund and have plenty of time for question and answer, hopefully. So strange year indeed. We saw what we usually hear in the investment industry, that market climbs a wall of worry. And there was so much worry this year, starting out this year. If you remember, we started out this year, inflation was still something we had to deal with. We had to deal with the banking crisis that happened. I don't even know if everybody remembers, that was this year in 2023, earlier in February. And we were all talking about hard landing and whatnot. There was a lot of confusion about, or rather not confusion, but fear about whether Fed is going to be able to control the inflation aspect of it. And yet here we are talking about 26.3% market return in the second line, S&P 500. And it's the biggest contributor to that was the first line item, mega cap return portfolio. Everybody's been talking about mega cap portfolio. If you go to Google and start typing ME, I think the first thing that'll pop up is mega cap. I get that feeling. Is what everybody's talking about. But other parts of the market on an absolute basis did quite well as well. The MSCI EFA, which is the developed market, was up 18% for the year. And that's pretty good, healthy, almost reaching 20% return. The Russell 2000, the smaller cap, underperformed the mega cap, of course, but still 17% return. And I'll take you all the way down to the emerging market that underperformed developed. So emerging has been struggling against developed market. If you could move on, Karen, let's look at some other slides here. So this is a slide we produced by JP Morgan. They do a guide to the market, and we saw some really good detail and data here that we felt is worth talking about. Well, and JP Morgan believes so as well, because they have kind of featured the same slide for a while, because this is explaining a lot of the market. On the left-hand side, you're seeing the green stocks are the green line represents the top 10 stocks in S&P 500. And they are giving us if you just focus a little bit on the box above, there is a valuation difference that is so remarkable. The top 10 stocks has a forward PE of close to 27%, while 27 times, while the remaining, which is the blue line, is 17.1 times PE ratio. And that's a big difference. This is basically the driver of S&P 500. It's the mega cap story in a different way, looking at a different way. And if we look at the second line item in that box, the valuation relative, well, the top 10 are 138% of the S&P 500 relative to S&P 500, while the remaining stocks are 88%. So, and that resulted in where the returns are coming from. 86% of S&P 500 return came from those 10 stocks. So that will be a big talking point for the rest of this conversation, and even our fund conversation. I wanted to spend a little time here. On the right-hand side, the top bar just shows something we highlighted in, I believe, in August or early in Q3 when we met. And back then we said the concentration in the market is getting to a point where we're seeing historic highs. Since then, a new high was hit. The top 10 stocks represent a bigger portion of the S&P 500. And the graph here shows how much of that percentage. Last time we hit a high was around the tech bubble, and we saw what happened after that. This time we're seeing a similar concentration happening. There was a little bit of adjustment, and then it swung right back up to hit to end the year with the new high of 32.1% market concentration. It just goes to show how top heavy the benchmark has become. And then at the bottom, it's just the contribution to S&P 500's earnings by the top 10 stocks. We're not seeing similar chart here. I mean, we saw a little upswing. The top 10 stocks were a big proportion of the earnings contribution. They reached a new peak, but then they're down again, kind of around the average. Let's move to the next slide, Karen. We added this slide here because we've been talking about this. Everybody's been talking about this, and we're trying to understand what's going on here. what we did was take a look at the same top 10 stocks in S&P 500. Sorry, the weight of the top 10 stocks. So that's 32% market concentration slide. And we then looked at, well, how do we explain the S&P 500 market cap weighted index? Market cap weighted index has 32% of its assets in the top 10 stocks, but then also look at all of S&P 500 equally. So there is another index called S&P 500 equal cap weighted index, and there each stock is given an equal weight. And we just wanted to see, well, how are these two doing over time? We know recently, it's not even a question, market cap weight has done really well. But let's take a look at over time. So what we did here was look at 5-year increments from that 1996 when the graph starts and look at market cap weighted. So the returns at the bottom that we overlaid here shows on the top market cap weighted index, and then below it, S&P 500 equal cap weighted index. In other ways, equal cap weighted index just is overweight as the mid cap, the small and mid cap stocks. And we're not trying to say that whether we should be equal weighted or whether we should market. We just wanted to see what really is happening. We see that in the beginning of this graph, the first 5 years leading up to that tech bubble, market cap outperformed. Market cap outperformed exactly, market cap weighted index outperformed as these top 10 stocks just grew. And it outperformed the equal cap weighted index by 8.5%. And then there was a correction soon after. Now the trigger for that correction was tech bubble, but there are different triggers for correction. That's what happened. It gave it all away within the next 5 years, just about. And then we saw a period of 10 years during which time we had market cap underperforming equal cap. That's the from 04 to 2012, we saw equal cap weighted outperform. And then following that, we see another 10 years of market cap outperforming. And finally, the last 4 years, 4 years, we don't have a full 5 year there, small outperformance. If we look at that entire period from 1996 to 2023, market cap has underperformed equal cap weighted. We don't think about that much. We're just looking at what happened yesterday, that mega cap phenomena, and we don't really think about this. Another thing, and we went back and said, well, what is the inception? Let's look at a little bit longer picture. We are long-term focused investors, and we want to be conscious of what's happening in the long run. Well, in the long run, and this is since the inception of the equal cap weighted index in 1990, it's outperformed market cap weighted index by 1.4%. That's interesting to us. We did not expect that when we ran that. We figured it probably turned already because of what's happening now in recent 3-year or 4-year periods. So I think I spent a little bit extra time here because I wanted you to bring you along with our thinking a little bit, but we can move forward now. I'll go a little bit quicker with next slide. Please stop me if there are questions.
Does anyone have any questions about this?
Yeah, I didn't get the it's not the years in the section below. What the one on the left is 96 to 2000?
1996 to 2000, yes.
Okay, and then 1 to 5, 6 to 10, 11 to 15, 16, 20, and 21
yes.
to 23. And then the last columns?
The last column are for the entire period altogether.
So 96.
Okay, I'm off here because I've got a leftover period. So does it start 90 to 95?
So the 90 to 95 was not in this graph, but we had the numbers.
Included
so
it,
we
yeah.
calculated that on the very last and showed you from 1990 till December 2023.
Okay, I was off 5 years. Thank you.
Sure. Okay, I'll move a little bit faster through some of these slides because they're just interesting data points talking about various valuations and parts of the market. So here, international valuations. We saw this year, U.S. market outperform international, but it's been happening for a little bit. There's actually a dispersion happening in the valuations of international stocks and U.S. stocks. One way to look at it is the PE ratio, and here we just look at the international stocks PE discount versus US. On average, international stocks do trade at a discount. The purple dotted line right in the middle, around that 15% mark, is the average. International stocks typically trade at 16% discount to US, but we are quite past that average. We're at 2 standard deviation of what we typically see. Currently, it's trading at 34% discount to US. So obviously, our international market managers are pointing that to us. They're telling us this is not something that they believe is sustainable. And they keep pointing out these discount valuation that's making international stocks cheaper. On the right-hand side is just the dividend yield comparison. Similar value stocks typically have higher dividend yield. International stocks also, if you look at the average line around that 1.2%, typically have higher dividend yield. International stocks trade at 1.2% to the US stocks in dividend yield, and we are at 2 standard deviation away from that. So that's also very interesting. Let's move on, Karen. Bond market, Karen mentioned, we had a nice pop at the end of the year. I think the last time we spoke, bond market was very flat, and then there was a big increase towards the end of the year. The Bloomberg US aggregate right in the middle, broad mix of corporate and government bonds, up 5.5%. for year to date. And if you notice, that came from that last quarter. The last quarter was 6.8%. We were US Ag index was actually below 0 quarter ago. And just focusing on where it's coming from, it's the higher yielding sectors. There's just a risk on mentality, and corporate high yield up 13.4%. Year to date. High yield typically behaves in line with stocks, not exactly to the same degree, but there's a high correlation there. Stocks are up big. We expect high yield to be up big as well. Just pointing at commodity struggled down closer to 8% year to date. Let's move forward, Karen. And this is why we've seen the yield curve. If you look at the yield curve from 2021, that's the one at the bottom. That's typically what in the past we expect yield curves to look like. They're typically upward sloping, and we've been in the inverted yield curve for quite a bit. And that 2022 and 2023 lines are right on top of each other. The longer term yields are pretty much in line during the year, but it's that very left-hand side, the short, really short-term yields have come up quite a bit more. It's up. If you look at the blue line, it's above where we started the year, green. Let's move forward, Karen. So, if you look at the market, there is expectation of rate cuts. There is already 6 rate cuts priced into the future market. That means investors are trading with that expectation that there will be a lot of rate cuts happening. Obviously, it depends on market data. Fed's watching every single market data coming out, whether it's inflation or GDP, and investors are watching every word coming out of Fed mouth because that seems to indicate where we're heading. But rate cut is in the near future. Let's move on, Karen. Okay, so GDP. this is as of Q3, and one of the things to highlight here is where the GDP growth is coming from. Is in US, it tends to be that blue box, which is our consumers. US consumers support the GDP numbers quite a bit, and they have done so again despite starting the year out with a lot of worry. Big blue boxes supported. So did government spending, and that's the green one. Now, there's a lot of question about if that can continue. There are other economic data points pointing at the fact that consumers' savings are depleting. The consumers are using a lot more credit because there are new ways banks are coming out giving you ways to spend. Our CIO Dave Zellner highlighted his bank is now, even on their debit card, is allowing installments to pay for it. That's not even a credit card, that's the debit card allowing installments to pay. So there are new ways for consumers to spend, and they are spending, but there's savings are depleting. And so there's question remains, can that blue box continue to be so big going forward? Same with government spending. We're expecting it to go down. So questions remain about where GDP will be. Let's keep moving. Inflation numbers, it has come down. We started this is the one bit we started the year thinking we're going to be able to bring it down, though questions remain how well, and it seems like we're doing quite well. The headline inflation as of November was 2.6%, while the core was 3.2%. December numbers came out, I believe, was it 3.4%? Boy, I have a lot of numbers I've been looking at lately. The core may have been 3.4%. Let's move forward. Okay, so this is a nice chart to look at. It's from Capital Group with the Morningstar data, and what typically happens after rate hike cycles. So the darker blue bar shows 1 year following the final Fed rate hike. I think the Fed met yesterday and kept rates steady, and in the near future, we're expecting it to go down. So there is a general belief that the last rate hike was done. And so what happens after that? And this shows what happened typically in the past. In the past, after the final rate hike, within 1 year, those dark blue bars show where returns are. Core bonds up 10%, US stocks up 16.2%, and a 60-40 blend up 14%. While a 5-year look at the number shows still higher numbers, though not as high. So these do outperform cash. It's something to keep in mind, even if there are fears of recession, and there's always geopolitical issues. There's still 2 wars going on, and there's conflict in the Red Sea. Even so, it is always a good idea to stay invested, and cash is not necessarily the way to go, just from the historical numbers. Here's a look at the market returns around a different way to look at it. It's different time periods and the months around the last hike and what happened after that. So just a different way to look at different time periods. Many of these were before my time. Let's move forward. Okay. Another thing to keep in mind, I'm sure everybody's thinking, we have an election year here, and what does that mean in terms of returns? Well, and what does that mean in terms of who is in power? It appears markets do well regardless. There seems to be not necessarily a tilt one way or the other, and just an interesting way to look at performance over time. 60-40 annual return. 2022 was a difficult year for the balanced portfolio, down a 60-40, 60% equity, 40% fixed income. shows down 16%, but 2023 was up 18%. An interesting chart, and we keep an eye on as many investors are invested in the balanced portfolio. Another busy chart here, more for later read, if you would, but just shows different asset classes over different time periods and where they ended. Not surprising, in 2023, we have large caps driven by the mega cap names up all the way at the top, while commodities struggled towards the bottom.
Hey, Raj, in here, where is international? I mean, I saw emerging and domestic, but I didn't.
Yep. So the second one is the developed market equity.
Which probably
Okay,
includes
so that's
US,
the
right?
international.
Would that include US? Probably not.
The
No,
large
no.
cap is probably the
it should
US,
not.
large cap, small cap,
Developed
mid cap. So thank you.
Yeah,
Yeah, it's always
believe-
interesting because what's on the bottom, maybe at the top the next year. So you just kind of never know where, you know, like if we think about emerging market equities, look at the bottom in 2011 and then towards the top in 2012. And then it's just, again, it's really hard to time the markets.
Commodity just went a complete swing, right?
Yeah.
From 2022
Yeah.
to 2023. And large cap, almost complete swing. It was towards the bottom half of the list here. Move on. Okay, well, that completes the market. Are there any other questions?
Nope. Okay. So I'll kind of jump right in. This is just a reminder of what's a multiple asset fund, how it is comprised, invested. You can see again where US equities, international, and then the two fixed income funds fall within this fund. This is the net of all fee performance for each of the individual Wespath funds that the foundation is invested in relative to its benchmark. So Raj mentioned that global equities finished the year strong with really an uber bull run that we saw in November. Again, as investors gained confidence that we would experience a soft landing. So all equity sectors were up for the fourth quarter. US equities ended around 26% higher for the year, and non-US developed equities ended up about 18% on the year. Bonds also, in the third quarter, returns were negative, but we saw fixed income ended the year strong in November. It really wasn't everything rally quarter that we had. So it was really a nice way to end the year. As equities reversed the losses that they had, bonds were also up. So everything kind of finished the year in green. And some of the reasons for the strong returns that we saw, again, the Fed, the dovishness of the Fed supported the markets. We also saw inflation concerns easing as inflation appears to be cooling. Inflation peaked in mid-2022 at 9% and then fell to 3% in November. So again, right at that time, we really saw the markets take off, both bonds and fixed income. But if we think back to 2023, we entered the year with this recession concerns. When's this recession going to hit us? We were in the middle of the year and in the summer, and the consensus was rates were going to be higher for longer. And then the end of the year, inflation was cooling. Everyone's calling for a soft landing. Markets rallied. So again, there's just been a lot of volatility. Again, just glad that the markets ended up positive. If you look at the 1 month returns for the multiple asset fund, you can see that they ended strong. We had saw strong performance from our equity funds, like our US equity fund for December up 6.4%, outperforming the benchmark index right in line, which is what we would obviously expect. We did see the international equity fund underperform, and that primarily was due to the private market investments that we had, which really the private market investments impacted both of our funds. So if you think about private markets, and these funds have a very modest allocation, only about 4%. So the valuations that the valuations that were used in the fourth quarter are third quarter valuations. So if we think about how the markets performed in the third quarter, private markets saw that in the fourth quarter. We have gotten some estimates from our managers because of the end of the year, and they are gauging that they will be higher valuations. So again, we will see a pop in the private market investments we would expect in the first quarter of this year. I talked a little bit, we talked a lot about the US equity fund and what's been the driver of the underperformance for that strategy, and those really strong returns that we've seen from the mega caps. International, it's really been an active manager story. You know, it's the cycle that international markets are in has been out of favor for our active strategies. And Raj pulled together some information that we'll talk a little bit more about. Moving our eyes to fixed income, you can see our fixed income strategy modestly underperformed month to date, but really strong long-term outperformance if you look at the 1 year and the 3 year. And then the same with our inflation protection fund. So it has really had some strong returns from both of those strategies.
Karen?
Yeah, Richard.
If you can skip back.
Yeah.
I think, I guess I'd point out, and particularly to the newer members, we did switch our equity fund that we offer into an index, partially an index strategy, which we hadn't used before. So obviously that has helped. That move has helped, at least in the short run, of improving our overall equity strategy that we offer.
Yeah, if you think about the 1 year return, so that was about 1 year. I feel like we did that. It was September 1st, I believe. Gloria probably remembers when we made the switch. It was September 1st of 2022. So if you think about the 1 year, I mean, you did gain an extra 3 percentage points by making that shift, not only in the index fund, but also out of international and putting more into US equities, as international still has trailed the US markets in the last year. So that did help making that switch.
Which is in the equity fund, but for the new members, the foundation's long-term permanent assets are all in the balance fund. So those funds did not have that adjustment. It's just the offerings that we make to our churches and the ones that opt to use their own, if you will, a la carte version of investing in an equity fund and a fixed income fund at their preference of allocations. Sorry.
And part of the work that Raj spoke about is, you know, we are looking at the multiple asset fund as well. We have an internal asset allocation committee for the client side, and then also for our fund side. And the multiple asset fund will be one of the funds that we take a closer look at and how that is allocated. I do want to remind everyone, we can create our own balanced fund. I mean, you don't have to be invested in the multiple asset fund. We could take your equity funds and your fixed income funds, and we can create a balanced pool using those ratios for you. So the fixed income would only be the fixed income fund, and the equities portion would have the lower international, and we can add in the index. So there is an option to do that if we want to, have that discussion more in detail. Happy to do that and discuss how we would do that and what that would look like for everybody. I know the multiple asset fund is very convenient for the foundation. It has the daily net asset value. It's one NAV that you have to strike rather than worrying about the underlying components. But we could see changes in the multiple asset fund strategy. Nothing in the near future, I would anticipate. And we could also do our own multiple asset fund for you all too. Moving on, this is the US equity fund. You can see what our target allocation range is and kind of where we fall. So you see this overweight to small and mid. Well, it's primarily coming from the mega caps. So we broke out mega caps and large cap because it looked like we had a significant large cap underweight when really we had a significant mega cap underweight. So we broke that out. So you can see we're modestly underweight large cap stocks. Really, it's coming from the mega caps. And then we have this modest allocation to private markets. That's also part of the fund.
And I have a question about that. If you go back, the note on there, the number one note says that the mega in this portion is defined by the Russell top 50. So, which is a different information than what was up earlier about the Magnificent Seven. Okay, thanks.
Yeah. We, typically when people think about the mega caps, they think about those top 7, but we look at it from the top 50 companies as the top largest 50 companies from that perspective, because we do this based on our holdings when we run this analysis.
Thanks.
And And the mega cap, recently the number has been 7. We had FANG, it changes over time. So we have at least one set of 50 stocks created by Russell 50 index, top 50 index, and easier for us to just monitor how that's done.
I won't spend a ton of time on this because we did really talk in detail about it, but you can see our active strategies performed really well last year. Strong outperformance by, Zevenbergen did well, who had a little bit of a rocky year the year before. They performed really well last year, but it really was, again, this mega cap climb that we continued to see was the decline. And Raj, I'll turn it over to you. This was a slide that Raj put together for the discussion, knowing some of the previous talks that we have, and then kind of coming into the meeting. Dustin's always really great about bringing in topics that, he's hearing from investors, and that the committee might also want to hear. So I'll turn it over to you, Raj, to kind of talk about this.
Sure. Can I also just touch on Zevenbergen? I think you just mentioned, Karen. I was earlier talking about how we let our active managers go in and out of spaces as they see fit. Well, Zevenbergen has an all-cap growth strategy, and of their top 5 holdings, Tesla was one of them. Nvidia, which was up 235% or so, was their 3rd biggest stock holdings. Amazon was up there as well. So we have active managers with a little bit wider, wider universe to invest in, choosing some of these names as they see there being good valuation still potential. Just something to keep in mind, because that definitely changes our overweight and underweight as well, as managers see a play there or not. So this slide here is a very interesting look because we track our fund's performance against peer groups. We've been doing it for many, many years. And back in 2020, we were looking at our fund performances and wondering what's going on. We had really good performance back in 2020. This is coming out of COVID. We saw our US equity strategy be in closer to the top 10% for all different time periods. With that 2020 year, we were the 7th best in that universe. And this is a universe of institutional investors, including corporate, foundations, endowments, healthcare plans. And we beat out of the 213 peer group, we beat out 93% of those names. And if you look at the 3-year, 5-year, 10-year, we looked pretty good, even that 10-year. However, if you now look at 2023, that's on the right-hand side, that's at the end of this year. While we still compare quite well against other active funds, it's changed quite a bit over 3 years, which goes to show how volatile the market's been. Near-term performances can move the long-term comparisons quite a bit. Then in the 10-year performance, about 3 years ago, we were 12th. Not same, but 10 years has been changed from 12 to 25th. So even on a longer term, the near-term volatility is driving our own ranking. It's interesting to note, though, that even though we, in US equity strategy, we underperformed in the short term against the benchmark, the median manager did so as well. Active management has just been very difficult while we see concentration in the market. That's something worth bringing out.
And then looking at our international equity fund, you can see here is that we're pretty in line with the benchmark. I mean, we're not making any strategic over and underweights. Again, this fund is about 85% actively managed. So we rely on the expertise of our active managers when it comes to our international equity fund. So again, you can see we're slightly underweight in EM and frontier markets, and then slightly underweight developed and it all kind of goes to the private market portfolio, which was the, one of the detractors for last year. But then it also was the active strategies were also detractors in the portfolio, and their investments in utilities and industrials. And Raj, correct me if I'm wrong, I believe it was primarily related to their was it the impact strategies, the low carbon strategies, that where the stocks and security selection is what impacted the most from this sector. And then Raj, I'll turn it over to you.
Yes, thank you, Karen. So the international space, our international strategy has underperformed. If you look at longer term return that Karen was sharing earlier, the 3-year return has not been good for international. And so we obviously want to look into it a little bit more. What's going on? And what we did here was we look at long-term history with our managers. We chose the 5 managers that make up about 50% of our fund that we've had a relationship with for more than 20 years, and just look at what's happening over that 20-year period. This includes, and I know it's a little busy here, so I'll try to walk you through a little bit, but this includes 3 developed managers that also have a little bit of EM investment as well as 2 dedicated EM managers. And we did a growth of a $1,000 portfolio, again, for those 5 managers. So if we had given them a $1,000 portfolio 20 years ago, where would they be today? We also added the fund benchmark, which is a light blue line all the way at the bottom. And we see that the managers have had various periods of volatility. They have gone through their own cycle, but have come out outperforming the fund benchmark over a long period of time. This includes, I want to focus just the last 3 years. The 3-year period just seemed to coincide with the peak that these managers hit. Coming out of COVID, our international managers, they held a lot of stocks that were international stocks that were related to healthcare, that were related to digital transformation in grocery stores or just entertainment. They had a lot of these names that really saw an uptick during the COVID era, and all of these managers hit a peak, but then they started a cycle of going down to and hitting a trough around the beginning of 2022. And the 3-year, when we look at our 3-year, we just see from that peak coming down. So our 3-year includes this big peak to trough drop. And that's interesting, or rather important to keep in mind, that the 3-year seems to have a natural cutoff when managers hit peak. And we're just looking at the drop part. And so that's why I felt like it was worth mentioning. These managers, we have conviction in them. We talk to them on a daily basis, and they tell us how they're positioning, and we believe they're still positioning correctly their portfolios, and they have a rigorous process that they maintain. However, they have seen a cycle go through in the last 3 years, and as a result, our international equity fund is seeing active managers detracting during this piece of the cycle, if you would. Are there any questions about? I know it's a busy chart, but I wanted to just include that. Okay, so moving on. This is that 3-year phenomena I wanted to show. And maybe here I'll start with the chart on the right. As of end of December 2023, our active managers were the biggest detractor in the international equity fund, and our international equity fund underperformed their peers, especially that 3-year. It looks pretty poor, 94th percentile. And again, 10-year number also looks pretty poor, 63rd, rather in the bottom half of the peer group comparison. But again, I'm taking you back to a 3-year look back. If you look at that end of 2020, when I put those numbers together, I was asked to go back and check my numbers. Could that be correct? Our managers were looking really good. The same fund with the same managers. We haven't made any big changes in our fund in this time period. They looked quite good. They were in the top 10 percentile for 1 year, 2 year, 5 year, and their 10-year was 19th percentile. The dramatic change here also goes to show how volatile international markets and how quickly pictures shift back and forth. So that was also something worth noticing, keeping an eye on, and I figured that would be a good thing to share with you guys. Any question? All right, we can move forward.
And then our fixed income fund, you can see it's a very diversified fixed income fund. It's 100% actively managed. We underweight treasury and government bonds. You can see in lieu of having diversified allocations and overweight to high yield, non-dollar denominated bonds, emerging market debt, developed market debt, our positive social purpose lending program, and so forth. So you can see really this underweight to government and treasury bonds has been a contributor to the fund performance, as it's outperformed by almost 200 basis points for the year. And really, it's all the diversifying allocations and PIMCO's skill at really navigating these sectors and the yield curve has really contributed to the performance. And then last but not least, our inflation protection fund. You can see this fund does invest in U.S. Treasury inflation protected securities, but it also invests in EM linkers and developed international inflation linked bonds, floating rate. And this is where you see that allocation of commodities. You'll also notice is the benchmark is primarily TIPS and commodities. So really these strategies is where we, I always call them like satellite strategies. So we have the TIPS, and then we have these satellite strategies that help with the performance. You know, this is where we're going to see where most of this outperformance came from, a little under 200 basis points, again, outperformance. And it was due to those satellite diversifying strategies. That is all Raj and I had prepared. I know